Hi everyone and welcome to my top 4 dividend paying ETFs for 2021 and obviously 2022 because we're halfway through the year. A lot of people have been asking for more dividend videos because I guess it's more the mental part, that instant satisfaction. Being told to invest in the S&P 500, people are getting sick of it, and I understand dividends, you get a hit, you see the income, you see the money coming in once a month, which I understand. If I point you towards my Questrade account, I bought Apple maybe 4 years ago and I'm up 100% on it. So I'm up $7,500, but I haven't actually seen any of this. I haven't seen the benefit. It's just unrealized gains in my portfolio. I know they pay, I think my dividends are like $40 a quarter because they pay every 3 months. So I do get a small dividend there, but I wouldn't say I wouldn't invest in Apple for a dividend paying company. So I guess if people want dividend paying ETFs, they want to experience this $7,000 gain on top of getting monthly income that they can reinvest or spend if they want to live off of it. I'm going to start off with my favorite, then least favorite ETF. If we start off at let me go to the very top, the iShares Core Canadian Quality Dividend Index ETF. It's a mouthful, but all you need to worry about is XDIV, XDIV. If you wanted to buy this in Questrade, you will just type XDIV and it'll be the one that says .to because it's on the TSX. So because these are Canadian. You click here and there it is. Right now it's around 23.10 per share. Let's quickly go over to it. Sorry, let me just backtrack a little. I'm doing a little bit of a different video. Just let me know if you like it. So this makes an easier editing video. I'm just going to be reading off of their website and then giving you my opinion and on why I chose it. So why XDIV? Low cost portfolio of Canadian stocks with above average dividend yields and steady or increasing dividends. What I like about this ETF is that they rebalance twice a year and they review every company to see if they'll have a cut in dividends or if they'll remove them altogether. So the reason why I chose this is for stable and consistent dividends, not necessarily highest yielding. Highest yielding doesn't mean stable and consistent. So you'll see slightly less yields here, but hopefully, like less yield is fine as long as you get it consistently. If we go over here, I do like the way they make this chart. They give us the exact breakdown of the annual yield per year since inception, which is 8.39%. It is slightly off the benchmark of the index, which is 8.56, but that's fine. It's always going to be a little less. But if you think about the market returning 9% a year, if you're saying, oh, this is what the market returns, you're slightly off of the market, but hopefully you'll be getting some monthly dividends in return. Scroll down a little bit. What do they tell us here? Nothing important. So it only holds 23 companies from the TSX. They rebalance semi-annual. The dividend frequency is monthly. Right now, the yield is 4.23. Let me see if Questrade says the same thing. 4.13. Okay, I guess the minor timing difference. And what else? Anything else important here? Nothing really. Where's the management fee? There we go. This probably has the lowest management fee of the 4 ETFs that I'll be recommending. Right now, the management expense ratio, 0.11. Pretty low. They're calling this a medium risk ETF, which if you look at the holdings, this is not medium risk at all. This is low to medium. I guess if you were to call bonds, which is just interest paying, low. Okay, let's call this low to medium. If you take a look at the holdings, the top 10 holdings, these should all be familiar to you. It's a bunch of financials and energy companies. So CIBC, Royal Bank, Bank of Nova Scotia, TD, your top, 4 of the top 5 are banks. So you are heavily focused on financials. One thing I don't quite understand, if we go to the fact sheet, when I was reading this, it says issuer weights are capped at 5%. So if we scroll up here, we see everything is at, a little above 5% or less. But then I go here and this is at 9%. So this ETF should be mimicking the index, but then CIBC is double on the ETF. Whatever. I'm not going to question BlackRock with their many ETFs. I'm sure they know what they're doing, but I just don't understand if this is supposed to mimic it exactly. Why is it double the weighting? But that's fine. Exposure breakdown. When you're investing in the Canadian stock market, we're heavily financial, which is a risk if something similar to the 2008 financial crisis happens in the US, but we have more safety precautions. We have less banks. I think we only have 6 or 7 big banks, and it's kind of too big to fail, protected by the government. So I am a little more comfortable investing, more heavily in financials. But that's why I'm recommending a few other ETFs, so we'll be more diversified. We scroll down a little more. There's nothing else to say about this. 4.23% dividend yield payable monthly. Not bad at all. If we go on to the next one, Vanguard's VRE. This is the capped REIT index. So the previous one I mentioned, so this is XDiv. XDiv specifically excludes REITs, which it doesn't say anywhere here. But I think they exclude REITs because they're trying to produce that stable and not volatile yield. And REITs consistently, they pay high yields, but then in the pandemic, they've been cutting. So I understand why XDiv has no REITs in it. But because I'm heavy in real estate, I do believe in the Canadian real estate sector. I do like the REITs that this index holds. So we'll be investing in VRE. If you want to find it, you will find VRE.to because it's on the TSX. And it does have a lower yield because the price has increased significantly, so 2.93%. But if we go further here, it has a higher management expense ratio at 0.38%, and they do pay monthly. I'm specifically choosing monthly paying ETFs, so you get that dopamine hit on the 15th of every month when you get the dividend. Let's scroll down a little bit more. So it seeks to track the performance of the all-cap REIT index. So I think the 25% is that no one stock will have more than 25% weighting, which is fine. It tells you their income distribution per unit. It started in 2012. So they do give us the performance. Do they give us annual? Here we go. Annual performance. They don't give us an average annual performance. So in 2020, they actually lost money, 12%. Let me try to see. Okay, so they're not really telling us. If we go annual, like when did they start? They started in 2012, which is 9 years ago. So if we bring up this, we'll go 87.74 divided by 9 just to get an average yield of 9.74%. I don't know if I did that properly. Simple math. So this does seem to be bang on to the market, which is the S&P 500, mainly because the dividends are usually generally pretty high on REITs. Growth of 10K. Oh, I should have looked at this initially. Since inception, your $10,000 in 2012 would have increased to $18,991 in 9 years, which is pretty good. Pretty good. You can also do a 5-year. I like the way these charts work because you could do a 3-year. If you need the money in 3 years, if you think your 10,000 would increase to 12,535. But obviously, let's just go since inception. Risk and volatility. Nothing important here. Let's see. So it has 15 stocks. Hopefully we'll get to see a couple of the holdings. Nothing important here. Region exposure, obviously 100% North America. Market allocation, fine. Retail REITs. Okay, so it does break down. So this does make it seem like it's diversified, but it's all in real estate. So it says retail REITs, office REITs. So it's diversified in real estate, but not overall in a portfolio, actually. There we go. So these are the top 10. Cap REIT, obviously being apartment rentals, which would be the biggest, and I understand. We have, so here's one. RioCan cut their dividend by 50% recently. So the yield on this ETF would have been higher. Choice REIT, I had 1,200 shares of this. Smart Centers, this is probably one of the first REITs I've ever purchased. I may or may not have worked here for 3-4 years, but I I'm pretty experienced in the Canadian REIT sector, so that's why I do recommend VRE. Moving on to the next one. This is XHU. No, what is it? Is it X? Yeah, XHU. And again, you'll look for xhu.to and make sure it says TSX, Toronto Stock Exchange. Right now, the yield is 3.36%. It is $25 per share. I selected this because I wanted exposure to the US market. Having your entire portfolio just in Canadian stocks, that's not diversified at all. I chose this because it has 75 high quality US dividend paying stocks, and they're all so that companies are screened for financial health and dividend sustainability. I know this isn't like 3.36%. It's not the highest yielding ETF, but I would prefer everyone have stable and consistent more than higher. If we scroll down a little bit, it shows us the return since inception, abnormally low. So these 75 companies have increased by 7.33%, but then the index, the ETF, has only gone up by 6.37. I'm not sure why, but this isn't that impressive. But past performance isn't an indicator of future performance. I do believe in these 75 companies. If we'll go see a list of them a little lower. So this is number of holdings 74, which is weird because it says 75 regardless. So they rebalance every 4 months. So they add and remove companies that meet their criteria for this ETF every 4 months, which is great. Dividends paid monthly, 3.35%, which is a little different than here, 3.36. This is not an issue at all. So let's go here. Nothing important. Nothing important here. Nuclear weapons. What is that? Okay. Fees, a little on the high side, 0.33% management expense ratio. Again, they say medium risk. Something must be up with the BlackRock website. Every ETF I find says medium. I don't think these are medium risk. Let's look at the top 10 holdings. ExxonMobil, one of the giant oil companies. Johnson & Johnson. This is probably one of the best dividend paying companies you could invest in. I would invest in this myself. Procter & Gamble, Philip Morris, Coca-Cola. Again, I think they've been paying dividends consistently for 56 or 60 years straight. These are all, if we go to all the holdings, these are all fantastic dividend paying companies. Oh, we have Pepsi over here. These are all just fantastic. I do recommend holding this in your ETF, in your portfolio. This is a more diverse breakdown. If we go to the Canadian one, look at how biased we are. This is the Canadian market. Financials, 59%. And then we go to the US. Financials are just at 5%. They are heavily involved in consumer staples, but again, only 21%, not the biggest deal. I guess that's it for XHU. 3.36% yield, not the highest in the world, but consistent and stable, which is important. Moving on to the final ETF is ZWC. This is my least favorite for a few reasons, but I chose it for the high yield. ZWC is the Canadian high dividend covered call ETF. So similar companies as XDiv, but then they're adding an additional premium element by selling covered call options to increase your yield, and it pays out monthly. If you search for it in Questrade, zwc.to, because it's on the TSX, you'll know because it says 7.16% yield, but again, that changes because it's daily. But this is the highest dividend yielding ETF that I recommended, but it does come with a little bit of risk. Now here it is. If you invested at inception, which is 2017, it was $20 per share. 4 years later, it's $18.20 per share. So you will be at an unrealized loss, but if you're planning on earning dividends or living off of it for 10, 15, 20 years, the fluctuations in price shouldn't bother you that much. What the most important thing is consistent and stable yields. So you'll be mainly living off of this 7.16%. The unrealized loss that you would have had these last 4 years, kind of annoying, but not the biggest deal if you're not selling in the first place. If we go over some of the benefits, they're saying this is for investors looking for higher income from equity portfolios, which I understand. Call option reduces volatility. really agree with that, because if the stock shoots up, then you'll miss out on that. So you miss out on some gains. Well, I guess that is reducing volatility. So if we scroll down just to read a little bit on their website, the distribution yield says 6.6%, but that's June 30th. I'm recording this July 18th, so it has changed a little bit there. The management fee is pretty high. So management fee 0.65%, management expense ratio 0.72%. Because they have to actively manage this a little more, they have to choose the call option to sell. This is more hands-on, which I understand you're paying double the fee of VRE and then 6 times the fee of XDiv. That was 0.11 and this is 0.72, so it's pretty high. Again, this doesn't come out of your pocket. You won't be paying them anything. It just comes out of the returns of the ETF. Scroll down a little bit more. Okay, nothing. I guess we have to change this. Price and performance. So it doesn't look that good, because if you invest 10,000 4 years ago, you'll only have 12,400 now. That's because the shares tanked a little, but it increased because you're getting the dividends and you're reinvesting, which is fine. The reason why I chose this, if we look at 2017, the total yield, the total payment was 112 per share. And then if we go to 2020, oh, it didn't update. 2020. There we go. It's 132 per share. So even though the share price went down over the last few years, you are getting an increased dividend yield. Then lastly, what I do like about this, so it says it has 92 holdings, which it's not entirely accurate because it has shares and it also lists the call options. So as you can see here, their largest holding is 5% of Royal Bank. And I like that nothing is above 10%. So not one company in Canada would influence this ETF too much. But if you scroll all the way down, you can see the call options they sold. So it says negative here because this is a short position. And again, it's not taking up room in their portfolio, but it does tell you what they're selling. If we look for RBC, they sold the August 20th covered call at 129.5. If we just go ry.to, so this is 127. So by August 20th, they're saying it won't go to 129.5, but they sold 2,500 call options, which is 250,000 shares. We scroll to the very top, we see they have 450,000 shares. So they are selling a little over half as call options. I think I did that math correctly. Let me know if I did it wrong. But if RBC goes up to 130 or higher, they won't lose their entire position. It's just a little less than half. And I guess once August 20th comes around, they'll do the same thing again, or maybe rebuy back into the ETF or into the shares. But I think that's it for now. Let me quickly reiterate. XDiv, you can go, if you have $1,000, you can go 25% in XDiv. VRE, you can go 25% in VRE. XHU, 25% here. And then lastly, ZWC. Again, you can add or reduce based on what you like. You don't have to include ZWC if you don't like it. It does have a high yield, but then a little more volatile. I'm probably going to, cut this video into 2 parts. I don't invest in dividend ETFs, mainly because I like selecting individual companies. I like doing the research. I'm more hands-on. My next video, I'm probably going to be doing my top 5 dividend paying companies that you should choose, that you should invest in. So this is for the more passive investor. You don't have to rebalance your portfolio. You don't have to do any thinking. You let them do it for you. Like again, these are rebalanced either twice a year, or XHU is 4 times a year. But I will be choosing a few companies that I personally like with high paying and sustainable dividend yields. So thanks for watching. Let me know if you even made it this far. This is like a 20-minute video. If you made it this far, if you like this style, so nothing is scripted. I'm just reading off the website and then telling you my opinion. Again, it's not as professional as my other videos, but it is a little easier to edit. Let me know if you like these videos or if you want me to do a little more research. Thanks for watching and tune into the next one.